Hey everybody, good afternoon. Welcome to 12-Minute Trading. My name's Doc Severson. I'm joined by Dave Lukas over here. Today is, what is it, Tuesday? It's actually Tuesday, the 2nd of January. Yeah, we're doing this one a little bit because of the holiday yesterday. So here we go. Here's a brand new year, brand new market we are dealing with, and it's actually operating a little bit differently today than it has for the last couple of months, which is interesting. This makes our life, it makes the premium more, available to sell, and it makes our jobs a little bit more interesting. So, Dave, what are you seeing in the market these days? What are you expecting for in 2024?
Well, first off, everybody, welcome to 2024, and it's great to obviously to be here with all of you guys and everything. The biggest thing that I'm seeing out there right now, and I've got an echo. Let me fix this real quick. There we go. I'll tell you what, the holidays things happen exactly as I expected, right? We talked about having kind of a grind up through the rest of the year into the end of the year. Got a little bit of selling on Friday last week, which I think was a little bit of the profit taking and stuff that you'd expect for some people locking in some gains that wanted to. And then today we're having a bigger sell off, and that's locking in profits to me. That's not. We've been talking about how, and we'll show it on the charts here in a second, that there is this need to have a correction. There's a need to have probably a 4 to 6% correction from these levels because of the exhaustion in the weekly charts. I think it's back half of January into February as we get the first Fed meeting that's coming our way, because I think if you look at the Fed Board of Governors that changes here, the voting members are some of the most hawkish ones that are on the board. So remember, every year the voting members change. So I think this next Fed meeting is going to be a little different than what we've been used to. And I think that the Fed is not going to cut 6 times this year. If they have to cut 6 times, it means there's a lot worse things happening in the economy and everything else. So that actually would hurt the markets as well. So I think what we're in for is, some of that correction and this is that time of year. Doc will pull up the charts. We'll talk about it. January into February, we usually get that softness, that correction time. And then that in this case, would set the higher low. And that's where we would go for the rest of the year. And most years, like election years and stuff like this, are positive years. And after a year like we just had, you typically see some follow on. So I'm thinking we're up 10 to 12% by the end of the year when it's all said and done. So that's kind of where I'm at for the start of the year right now and for what I'm seeing.
All right, I'm going to bring up the charts here and take a peek at what's going on. So if you say that we've got a 5% haircut in mind, this is about where 5% would be, which would be a retest of that breakout that we had into
4,600.
Yeah, into early to mid-December is where that breakout came from, this consolidation. So, but the issue here technically, and this is what we've been talking about for weeks, is that we now have a very, very exhausted weekly chart, like an amazing 600, almost 700 point move here in just a few weeks.
That is the lowest reading in 3 years.
Yeah.
On that chart for the energies.
Yeah. So range expansion typically goes to range contraction. So we may be getting some, now this is going to be interesting because the higher and smaller this consolidation becomes, the more bullish this is. Mm-hmm. Okay. So On the other hand, like if we see something which goes all the way down to 4,600, that might not necessarily be, that would be kind of a replay of what we went through back here in June, July. Do we really need to go through all that again? I don't think so. So what I'd like to see is if it does stay above maybe 4,700, somewhere in this area like that, that would be extremely bullish. That would be, I'm not sure if I could hope for something like that. However, like Dave says, we may be ending up, coming back down to 4,600 at some point, ultimately restoring. This is like winding the spring up for the next move. The problem here is, like, if you count back some of these, and I've gone back to 14, by the way, for all my charts, because we are now, I believe, back into quiet and trending. So we're not as fast. This is what's happening. It's very persistent, very slow now, which is very, very different from what we went through in all this stuff here, right? So That's part of one of our jobs is to understand what the market, it's almost like we're weather forecasting to some degree. Like, what is the character of this market? It's very choppy, very, very frenetic, very high volatility versus what we're seeing right now, which is the opposite of that. So we have to adjust our charts to that. So yeah, we're going to be watching for this in the near future to see how tight this little consolidation is. And again, if it's very, very tight, that's actually a very bullish sign.
Mm-hmm.
But we may be going on for the next month or so. And, there are some precedents.
It'll take 4 to 6 weeks to, if you go sideways, that's your other option, is just to go nowhere for 4 to 6 weeks and charge that weekly back up. That's rarer, but it's, we've kind of seen some of that through this move. You can see on the monthly chart there, we, went sideways for a little while. So that's possible. I just think it's easier right now to have the pullback to hit that level.
Now, here's something that may happen, because this daily chart, you're already seeing it starting to recharge. And we may see this, grind around, like I said, in a very small range. And so this is going to recharge the daily chart. Again, this is the 2-year-old in the back seat on a long family trip, wants to go somewhere. And probably from there, it's going to be very difficult for us to break higher, even though like we're literally inches away from all-time highs. There is certainly some impetus for the market to go tag the all-time highs and just call it a day. But when we run into things like this, where you have one chart fully charged and the other one the complete opposite, what makes them both happy is if we consolidate and then we drop back down. And usually by that point, we're ready for a big slingshot move. So this consolidation catches a lot of people, acts as a bull trap, gets flushes them out through all that pain. And then the underlying bid, the patient investors, the smart money shows up around 4,600 and really drives the bid higher from there. So this may be, if I had to take a guess, this is what we'd probably be seeing here into the month of January and February, is something like this.
I think we have to get a catalyst, though. So the one thing that, the market, all it needs is an excuse at these levels. When you got a daily chart, that's the lowest energy it's been in 3 years. It's in complete and total exhaustion. It doesn't have to immediately start selling off. In fact, I was talking to my students in the newsletter this weekend about this. Like, just because we flip over to the new year doesn't mean we have to start selling. Now, we're selling some today, and we'll see, how that pans out. Maybe we do. Maybe we just flip over and this is it. We just start selling off and put in 4,600 and that's it. That seems really, really easy. Seems too predictable, right? So that's why I said I think maybe today's just people locking in gains and resetting for the next year. But it'll take some sort of catalyst typically, to really make this thing get scared, right? That could be something overseas. It could be something that, I guess it looks like we're now in combat with the Houthis that are firing missiles at people in the Persian Gulf area and stuff, or it's affecting the oil trade. It's one of the reasons that oil's up today. So it could be anything like that. And a lot of times when it comes about, it's not that big of a deal, but in hindsight, right, it's always like, oh yeah, that was the catalyst. So I'm just wondering what we're going to see maybe over the next few weeks as we get into this year. Maybe it's another Taiwan, China thing. That's what spooked the market a week ago and made the SPX sell off 70 points, in one day. It was a rumor of that, right? Which turned out to be nothing, but at least for now. We need something like that to come in. Just an excuse. All the market needs is an excuse. You've seen that time and time again, where the market just finds the excuse, The
market will find the piece of news that it needs to be able to make the move that it wants. What most retail traders are like when we see a move, they're like, hey, what was that? What happened to make the price move? And a lot of times there really is no news behind it. There really is no catalyst. It was just the market saying, hey, you know what? I need a break here, or I'm ready to go. I'm ready to break out. Something I wanted to show you here from, there is a little bit of a historical precedent for this. So if you go back to 2004, I know this is really kind of dating myself here, but this was a year-end move. We had a hell of a year-end move. Back then it was like from 1100 all the way up to, what is this, 1220? So 120 point move. Back then, that's 10%. That was a huge move at the end of the year. And so for those keeping score at home, that was the '04 election. So this was when the market figured out, like a couple of weeks before the actual presidential election, that Bush Jr. was gonna be elected. Go figure. The market is smarter than the voter. So that happened. The market ran in advance on certainty coming into the market instead of John Kerry being elected. And then what happened is the very first day of 2005, when everybody was celebrating, what do? We dropped, 5%, and then bounced up and then dropped down, another few percent. So we pretty much gave up everything on the breakaway. So this to me is a very similar historical precedent towards what we might be seeing. Now notice that the overall trend did not change. What Dave and I are not saying is that we are not going, we're going to double top. I mean, I've already started seeing stuff on Twitter over the weekend about, we're going to double top and we're going to end up, down at S&P 2700 in a couple of months.
Biggest double top in history. Right. Batman ears.
Right.
It's over. So we're dropping 80%.
So this is more of just a typical ABC corrective wave, and then off we're running on the next impulse wave after that. So
higher low.
Right. So we've sort of seen this type of stuff before, albeit we have we're
just go through time and
different.
look at January, February every year. I mean, talk about seasonality. Just look at it for each year. I mean, just about every year you have volatility in January, February. If not a decent sell-off.
Well, 2002 was definitely interesting, and then when we got into 2023, wait a minute, am I on? Yeah, that's 22. So let's go to 23 here. So 23 actually turned out pretty well, right? So here was 23. Because this is the higher low that we set. So this was the point. Here, this is just over a year ago, and this is where everybody was comparing the current market at that time with a double top and saying, hey, this is just like 2008. So everything was extremely negative at this time a year ago, right? And then, so what did we do? We printed that massive higher low and then squeezed everybody out. So yeah, we do have some interesting moves at the beginning of the year. Oh, by the way, for those of you that are joining us here today, for those of you that are live with us, if you have any questions, Dave and I will be here for another few minutes. If you have any topics you want to bring up, go ahead and poke them into the chat room. If you're watching this on a replay later on, which is probably what most of you will be watching, so go ahead and send us a note, support@12minutetrading.com, and we can include your question or your topic on next week's session. We'll probably do this on Monday, I guess. Monday next week. And then the week after that, we have Martin Luther King Day. So we'll probably end up doing another Tuesday session.
Tuesday. Yeah. I'll tell you what was interesting last night. A lot of people weren't paying attention, but there was a lot of chatter about it on just the financial headlines and even Twitter and stuff is the bond rates are getting interesting. The 1 month shot up 70 basis points last night, like in the span of minutes. And it went from like 530 something to over 6%, for the 1 month rate. So that's maybe a change over the beginning of the year, but there's been these little glitches happening in the bond market overnight. They seem to resolve themselves by the end of the day, but Japan's still in the mix. You got this stuff going on. I just keep watch on the bond markets. I don't know if we're going to wake up one day and just see something really, really, crazy happening in the bond markets, because the bond market is, we always say, probably smarter than the stock market. The bond market's going to move ahead of everybody else by a lot, and even the stock market itself. And so it's really it's just kind of interesting to see the bond market doing what it's doing. The interesting thing too is like one of the things that kicked off this rally, right, was where bond rates started to go down, right? Now, what was the reason that bond rates were going to go down for like the long term, the 10-year and that sort of thing? Because remember, the 10-year and those longer term rates are not, they really aren't dependent on the Fed. That's true, fair, market capitalism pricing those out. And so a lot of people are saying the bond market is sniffing out ahead of time that maybe there is going to be some softness in the economy. Maybe things aren't as good as things are looking to be. And so the smart money is going to more safety in locking that in, right? And that's what did that. So I don't know if that'll be true in the end. We'll see. Again, it's an election year. Typically, these years are up. I think historically, they're pretty much like 90+% of the time always up. So, but the bond markets are a thing to continue to watch. They are smarter than the stock market. So just remember that. Doc, feel free to add to that because you've been watching those for years too.
Oh yeah, no doubt. Well, I'm not a bond market expert at all. I know some people that are, and they're so tunneled in on that. It's interesting. I mean, now that you mentioned that, that's the thing that's great about trading is like I know people that are just dead to rights on volatility trades. That's what they do. They trade mean reversion on volatility, and they just crank the wheel. I can't understand for the life of me what it is that they do. They've tried to explain it to me. They talk about, I can't even remember the terms that they brought up. Contango and backwardation and things like that.
Oh, yeah.
It's so easy to get confused on those, even though I know what those terms mean, but it's like the way that they're playing 3D chess in their heads on things like this. Mm-hmm. And then there's people that specialize in bonds, which is, as you pointed out, is the biggest market out there. You and I kind of have our own little specialty around the S&P and the NASDAQ.
Right.
And, I had a question in today's chat room, like, why are you trading the S&P? And I said, well, this actually goes back 20 years because I had turned into the jack of all trades and a master of none. I was doing all these strategies. I was all over the map. And I was not really making profits. I was slowly dragging my account down. And the only person that was winning was the broker with commissions. And so I just literally cleared my desk off and said, all right, I'm going to pick one chart, one strategy. I'm going to specialize in that until I become an expert. And I was amazed at how fast it went. So for those of you that are out there that are like struggling, you're treading water, you do okay, right? You push the stone up the hill some months, and then some months it comes tumbling back down again. Probably the best thing that you can do to yourself is to find one thing and specialize in it, what we call the rage to master. Find something that just gives you that, intense curiosity that you just can't put it away. Next thing you know, you look up and it's midnight because you've been working on something. So believe it or not, there's things that Dave and I do that still keep us fired up like that. So we're on a couple of new missions that we're going to be starting out in this year, and it's find a thing that gives you that sort of pull towards it. And
yeah, we're going to unveil a lot more on that. We're going to towards the end of this month, we'll have our annual year-end review event. Those of you that have been with me a while know I do this every year where I go back through the year and now Doc too, where we kind of look back and say, okay, what did we do right? What did we do wrong? What strategy changes are we going to make? What makes sense to do going forward? Because it's strategies that worked in the past don't necessarily work in the future, right? There are times for these things and there are seasons to the market. Like Doc mentioned earlier, getting back to quiet and trending. Doc, pull up a chart real quick. Pull up like a 1 year or something. We'll talk a little bit about this because I think this is really important to understand the different market types for you guys, because quiet and trending is really the kind of default state of the markets. It's where, we don't have these massive moves down and we just kind of plot along and we, head higher, and then you have these pullbacks in between, maybe 5%ers and stuff, but then you just keep going. But the positive drift just continues over time. And so that's, I think, when Doc says quiet and trending, you can kind of see that 09 through 20, that's very much quiet and trending, right? And then we got a blast off. And that's why everybody is saying right now, because it's been fueled by all this printed money. We printed we're at 4 trillion in debt, right? And 20 of that plus has come in the last, 5 to 8 years, right? So that's the reason you see at the top up there where everybody's like, oh, it's a double top and we're going to mean revert back to, S&P 3,500 range and stuff, which will continue that historical kind of, trend going, if you will, right? If you follow the line. And so again, it's hard because when you print that much money, it doesn't just get through the economy in like a few years. It takes decades. So that's why Doc and I are like, I don't think we're going to see this massive 2,000 point drop in the S&P, because the default state of the markets, especially when you print money, is to go up. Assets, things that have real value, go up, and they go up not because they're actually gaining value. They go up because the dollar is losing its value, right? And so this positive drift, is just where the default state is. And usually we're in those quiet and trending periods like Doc is circled on the screen, where it just kind of plods along and you've got these, intermittent pullbacks that happen and everything, but you're still grinding higher over time. You're not getting 12 to 15% moves in the span of 4 weeks, typically, right? But you are, kind of grinding higher. And that's why, like, selling put spread is one of the easiest strategies to do over time because of this positive drift. And that's one of the things that, like, I was famous for doing, right? And my entry criteria, the way that I do that. But the point is that this is what we have to realize, is that we've moved on probably from the bear market, which is the top yellow circle on the screen, to now back to that kind of quiet and trending. But we've had one of those 12 to 15% moves in the span of 40 days or so. So we need to, come back in line a little bit, and then, that'll be a pullback a little bit, setting that higher low, and then you'll get quiet and trending like those purple circles you see, for a good part of this year.
Yeah.
That's really how it'll go.
The thing you notice about these things, so what I've done is all the magenta is the quiet and trending, and then in the yellow, this is where we have what we call corrected periods. And what always knocks out the retail trader is this transition, the transition to corrective, just about. And what you'll also find is that normally this is at the top of a rally. So this is when most of the retail traders are saying, okay, is it safe to come in the water now? And as soon as they do, and this is why they feel betrayed and they feel like they can't trust the market, because this is part of the transition that every retail trader needs to understand. It's like, you've got to determine whether or not you're going to be on the side that understands history, or whether you're just going to be, part of the herd. And so this is why we're always, when we transitioned from like 21 to 22, we were definitely very, very, like, that was a hell of a move here from the bottom of the pandemic to the top. So we were very, very protective and very cautious about this. And by the same token, when you get moves that come out of the bear market into a new quiet and trending, this is the time for the iron to strike. However, most retail traders are like, oh, I'm scared. I'm still, because most of us are still living in yesterday's market. So this is where having a sense of history and about how markets move will really create a lot more of an edge. And then when you combine that with the right strategies, this is where you can start to really put together some consistent results.
An interesting thing, Doc, you were talking about the retail, and you could, we may be ending up being another red arrow just at the top of where we are today. But, in the weeks to come. But I think it was a week or two ago where we had the most inflows into the spiders in history, into the SPY. It's like 20 billion or some crazy number flowed in on like that week into it. That's another sign that the retailer trader is now feeling safe to get all in. And typically when you start to see those things, and it's markets can only go up, right? that's when you see the big boys fade those guys and take their money. And then
Yeah.
they reset. In this case, could be like 4,600, maybe 4,500 if it wanted to do that. Just take that money off from them and then turn around and do it again. And it's the same pattern over and over and over again. So yeah.
Yeah, it's all about learning how to ignore your feelings and ignore the, you know, I guess you'd call it the conventional media, the standard, where if everybody else is getting the same information from the same old sources, then what's your edge? You don't have any edge. And so it can be really, really sort of a very lonely existence if you feel like you're going in the opposite direction to the herd, but that's where the edge is. So it's not the easiest thing, and it doesn't come, it doesn't come in a month or something like that. It does take a while, and this is why we try to help our customer base through transitions like this, and when to be aggressive and when to be a little bit more cautious about the market.
Yeah. In fact, sometimes many times, most of the time, the best trades actually feel the worst. Like right now at the top, if you own stock and stuff, I mean, now's a great time. Sell your covered calls at the money and let things fall away from it over the next 6 to 8 weeks and buy them back for cheap. It probably doesn't feel good, like, oh, I'm going to get my stock taken, but there's a better chance that you won't from where we're at and stuff. So if that feels bad, it may be the best trade. We found that.
Worst thing that could happen is you just have to buy them back if the price continues to rally. So,
yeah.
Well, we have finished our time here today with you guys. So thank you very much for joining us on the brand new year, the second day of the new year. So we got 364 days to go and 251 trading days to go as well too. So
yeah,
thanks
this is going to be
for
our best year yet, though. I think we're as dialed in as ever. So this is going to be a really fun year to go through with us, I think. And we're going to have some great stuff. I think the style that we have adapted coming into this is perfect for where the market's at, but we've got the other types of trading strategies for if the market turns and stuff. So we're kind of ready for the different seasons of the market. So I'm pretty excited about this year.
Big time. All right. So thanks everybody for joining us, and we look forward to meeting you guys next Monday. So we should be around next Monday. So sayonara from myself and from Dave. We'll see you guys in our next session. Adios.
Bye, everybody.